Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. The Indian economy has been witnessing quite a downturn. The equity investors are anxious as to how their investments will fare. We will talk about all these points in today's Investors Hangout with the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
So what are the reasons? Let's get first to the reasons of the economic slowdown. Is this a problem that one needs to be worried about? Or should I go to the first part of the question? What is the economic downturn?
Economic downturn is that, it is actually deceleration, to be very precise. Because slowdown meaning, we were growing at a faster pace. Now we are growing at not that fast, at the older pace. So it in effect is deceleration, and it's quite understandable. The kind of changes that we have witnessed in the last 3-4 years. I don't think it is surprising that we have this slowdown. It is almost like a operating system, the way you have it, the way we had. It's a complete change. It's resetting of many of the things. Also, it has driven some degree of sincerity in things to be done right, and it naturally has an effect. And then slowdown, and markets are our economy is cyclical. As we you can look at this graph, 20 years and we have never a very steady state where we keep rising and growing steadily. Few years of rise, few years of decline, and that's a natural course. So in that sense, but this time it is happening for reasons which are external. A sectoral cyclicality is understandable. Business cyclicality is understandable. But this time what we are finding is that, the operating system changes, and that having an impact on the way businesses conduct their affairs. This is going to, a lot of people have this opinion that, 6 months, 2 quarters, 3 quarters, I don't know, it could be longer. This can also turn out to be a big shake-up for a certain kind of businesses, or certain businesses which used to conduct themselves in a certain manner. They will get phased out, and certain businesses will actually thrive and prosper as a result of this. What is being done to incentivize or to kickstart the economy is also not being done in a very haphazard way, is not being done in a very ad hoc way. It is being done, of course, something needs to be done, but nobody knows what exactly. The corporate tax rate cut, that's one. Giving money in the hands of consumers, that could be another. I think we should expect something in the budget. But at the same time, I think, the resetting of the operating system, I don't know how long will it take. It will have, big winners and big losers as a result of that. That is going to be very painful for many businesses. We have already witnessed that. And the small changes are not small. The changes are, one, irreversible, and they're quite fundamental. Businesses never used to go bankrupt in India. Now they do. GST, a lot of businesses could actually get away without getting into the tax ambit. Now it won't. The kind of information economy that we see today, it is very difficult to escape. I was just looking at the way we conduct business. And you have 4 parts to the business, so to say. You have the balance sheet, and you have the profit and loss account. And at every stage, the way we conduct business, everything is getting reported, everything is getting accounted for. In fact, we are coming so close to a situation that if the government wants to, they can send us a tax bill on 15th of March every year, that this is what we owe them, or this is what we actually deserve a refund. Because all the expense heads, all the income heads, they are getting captured while we are conducting business.
Okay.
Because you pay GST, you pay TDS, withholding tax, every time an employee is being paid, all the expenses is getting recorded and getting aggregated. The digital economy, everything is getting captured in your bank account too. All the money coming in, all the money going out. Balance sheet. You have the investment assets and the liability. And in the asset side, you have assets which you can have some money being realized by sale of assets, or liability. So all those things, or even those transactions, securities transaction tax, registration duty, all other things getting captured. So I think it's pretty straightforward for government to keep an eye on, so conducting business the right way will get rewarded.
Okay.
And businesses will thrive only when they are able to build by a competitive advantage by a combination of, variables, whatever it be. But crooked means are going to not going to get rewarded, or it will get it will not be the old way, so to say. So I think it's good, but I'm not sure if it is economy is going to bounce back in a hurry unless there is a huge government intervention, which itself is a problem sometimes because that leads to all kind of distortions.
Okay, so what you're saying is the operating systems are going to change. Business framework and economic framework is changing, and
It's
that
already
will
changed.
take time.
Yeah. It will take time to settle in.
Yeah, and for it to show results to us, it will take time.
Yes, and the results will be positive.
Okay, that
Though that I'm absolutely sure of.
Okay.
But but we may not bounce back in a hurry.
Okay, so would it be right for us to say that the growth story of India is intact?
Oh, growth story of India is intact. You have the consumer base. We are doing the right things. We are actually bringing in meritocracy in business. So undoubtedly, and this will have lasting impact. We just might be getting closer to realizing our potential of having a huge captive market, and then we can go about conquering the world. And the kind of incentive system being worked for companies, we can actually look forward to genuine, credible Indian multinationals coming in the next 10-15 years. And that will have its own rewards. We haven't had, too many outward-looking, competitive businesses with great competitive advantage. So that could be, that is actually very optimistic thinking. But I think, the variables which has to be nicely in place, they have fallen in place. How long people can reconcile with it, get used to it, and use it as an opportunity is a matter of time. Now, should one be, how to configure yourself around this, all the turmoil, all the kind of crisis which we see in the fixed income market, the kind of decline we see in the mid cap and the small caps, and the turbulence in the market, that's a different story. And I think investors need very clear-headed approach in addressing that.
Okay, we showed the chart to you a while back, and I just want to go back to that. That historically, that we have seen GDP at constant prices versus Sensex. How the economy or the nation bounced back every time. You just want to give few examples as to how what were the factors that drove the economy down, and how we overcame that and did pretty well in certain years.
Yes, I think that's just a matter of fact. The fact is that despite the cyclicality of the economy, the market has steadily gone up. If you look at the long-term direction of the market, despite the turbulence, we have seen 19% annualized return over the last 35 years, getting ahead from the Hindu growth rate, what used to be 4.5-5% for India. For many years, we crossed 9%, 10%.
And the case in point will be 2008. We really
2008 went low. But this was actually, this was a complete turnaround in the investors and business sentiment. This was the result of the global financial crisis. What the government did as a result of it to kickstart the economy immediately actually had a very significant negative impact for the economy. Because once you start, once you kickstart the economy by distributing money, easy money, by just maintaining, a policy whereby credit is available readily without many questions asked, then it creates, a kind of less objective. And that is why we see the NPA. That is why we see the banking sector struggling over the last 10 years. But if you look at, but variety of reason, whether it be bad monsoon, whether it be a global crisis, whether it be our own banking crisis, whether it be the opening up of a sector to foreign competition, a variety of things. But despite all that, we see the cyclicality. So cyclicality of market or economy is inherent. But one has to see that, what happens in any 5 year. Any 5 year you see, the market has gone up.
Yes, okay.
And the general direction is only up.
Okay, in the given downturn, in the given scenario, I should say, what should the existing investors be doing?
Oh, we sound very boring. We sound very repetitive. We almost sound like a stuck record. But keep calm and carry on. That's all there to it. Because, you have absolutely no control on any of the things which is happening. And the control that you have on is your way of, you have the best understanding of your time frames. Okay. When you are likely to need the money, when you want to buy your house, when your child will go to the college, when you plan to retire, or when you will retire. If you many a times you don't even have to plan for your retirement, you retire. So in that context, I think just focus on what you can control. Invest your long-term money, be methodical about it, be regular, diversify.
Don't time the market.
Don't time the market. So being regular itself means don't time the market. At the same time, don't negotiate on the fundamental principle that diversify, because last year large caps did well. 2 years before small cap did well. Don't do even that. Make sure that you're in the multi caps, make sure that you're evenly spread, make sure that it's 5 years and more, make sure that you're regular. If this is done, make sure that your short-term money is never invested in equity. Make sure that you're not borrowing money to invest in equity because the markets are doing well or you think it will do well. Don't over leverage. So if you have these variables in place, I think one will be one of the biggest beneficiary of all the downturn that we are witnessing.
Okay. So you think in budget is just around the corner. Is that going to give an impetus to the market?
I think so. But nowadays budget is not a very important event or a milestone, because earlier a lot used to happen in budget. We used to look forward to budget because everything will happen on the budget day. No longer. Today you have, a GST council meeting happening every month. You have this big announcement that came on in September, which is the corporate tax rate come from a retrospective effect. And a lot of other things, a lot of fundamental, financial things actually happen during the course of year. If the government has to take a stand or, make a policy change, it happens without waiting for the budget. So in that sense, budget is no longer that relevant. But, the economy is at a point where the government is working very hard. Few months back, we saw that every Friday or every week, the finance minister coming on record to make some announcement of streamlining the process, streamlining the procedures. So I think, budget is not that important. But yet, yes, how much of a leverage government has, in terms of financial accounts, how much money it's getting, how much money it's spending, what are its spending plan. And this year's budget is particularly important because, individual investors in giving money in their hands, releasing money in their hands in a meaningful way, how it can be done, I'll definitely be looking forward to it.
Okay, so this is for the regular investors. How about those who are on the verge of investing or are planning to invest? What about them? Should they wait or?
No. Waiting is a loser's game because, what happens is, if you look at any 10-year return, good part of the return actually happens on 30-40 days in 10 years time frame. Markets turn around or markets go up when you least expect it. Okay. And basically you have to remain in the market or remain invested for 9 years, 11 months for those 30 days where most of the returns will be generated. And you don't know when. So that is why you have to really remain invested, start investing, and ignore the noise to begin with. Because initially, it's human, behavior that the moment you start looking at it way too closely every day. Right. And that is actually a loser's game. You have to work hard to ignore it and start your accumulation. In fact, that is one of the biggest challenge for most investors, waiting to start when it will be opportune, and then you leave, you miss out on a huge opportunity.
Quickly, tightening of norms we talked about in the beginning. What if in the budget some more tightening of norms happen through the budgetary provisions that the government make, because of which the businesses may be affected? Then what happens? Again, we are going to get into that negative sentiments.
I don't know. We can't really rule out surprises. I think most of the negative surprises for the market or the economy is nowadays coming from the courts, not from the government. If you look at the telecom crisis, or they being asked to pay up, and that leads to complete unviability of a sector. So in that sense, I'm not expecting that. But at the same time, we have come across situations in the past where the government has taken a step, and a small step, maybe not a very damaging step, but the market perception of it is disproportionately negative. So a government at this point seems to be very sensitive to kickstart the economy, and we have to see how they use their imagination. I'm not expecting a very normal budget this year. I'm expecting something dramatic being done, so that it should just not be a sentiment enhancer. It should be something very fundamental, that people get more money. People, if they are sitting on money, they should be active. They should be incentivized to get started with their activity. They derive the confidence. We get something liberal in terms of all the kind of tax nuances which is leading to deceleration or scare or fear. That needs to be really, getting back the animal spirit. The set of things that the confidence, in businesses becoming more, sure of themselves, that okay, here is the opportunity, make more money, less taxes, and do business with confidence. So that I think is something fundamentally needs to be done, and consumers getting more money in their hands. I think government has very little room to do, but reduction in personal tax rates.
So what Dhirendra is saying, that the growth story of India is intact and one should continue to invest regularly. What we've been telling you all this while, that be regular in whatever investments that you have planned for yourself. We now move on to the Q&A part of our program, and the first question has come from Jeba Kumar, and he says, I'm approaching my retirement and I will get a corpus of 60 lakhs. Please tell me, how should I proceed with the investment plan?
I certainly need more information in terms of what is the income expectation. But 60 lakh rupees, I will just give a broad principle. Not possible to give a very specific advice in the absence of information. One is that the objective of this money should be to invest in a manner that it can beat inflation and you can derive some meaningful return continually. And for that, if you have never invested in any market-linked investment, then you have to follow an asset allocation so that you are able to derive 6 to 7% return on 60 lakh rupee. And 6 to 7% return, which means about 4.25 lakh rupees a year, and that much return will ensure that you will asset allocation of something like 1/3 into equity, 2/3 into fixed income will make sure that you are able to generate that kind of return. Plus, you'll be lucky, 1/3 of the equity, 1/3 of your money invested in equity, which is 20 lakh rupees in case of 60 lakh rupees retirement corpus, will make sure that this 4,25,000 rupee which you'll make in the first year, this can potentially get revised with your capital rising, because if you invest all of it in fixed income, the money will remain constant, and 5 years from now, 10 years from now, your need for higher income in line with inflation will not be met. The way to deal with is, so work on the asset allocation. Okay. Of the 60 lakh rupees, 40 lakh to be invested in fixed income. You should fill it up with senior citizen savings scheme, post office MIP, and then remaining in fixed income fund, and 20 lakh rupees in equity. And you will start getting your income from the fixed income, which you can consume. Equity, leave it alone. And one more important guideline which I would like to provide, that the 60 lakh rupees fixed income can be invested at one go. The 20 lakh rupee to be invested in equity must be spread over a longer period of time so that you eliminate the risk of catching a market high. Okay. So 20 lakh rupees to be invested in a multi-cap fund, that should be spread over 2 to 3 years, because it's a very important money. And the pain of interim loss with your lump sum investment in equity is very difficult to settle with.
Okay. Suresh Agarwal writes in, he's 76 years of age, and he's going to get money out of the maturity of the Senior Citizen Savings Scheme in April, and he wants you to tell him how to invest this money, and he doesn't need the money for the next 2 years.
The design of Senior Citizen Savings Scheme is that you invest 15 lakh rupees, you get quarterly income. It is possibly the highest guaranteed fixed income available for any scheme. 76 years old, you don't need the money, and if you don't even need the income, then I would say that you should consider enhancing, investing in a manner so that it can earn little more. One advantage of investing in mutual fund is that if you don't have income requirement, or if you don't have a periodic disinvestment or a withdrawal plan, then you don't owe any taxes till you sell them. So if you invest 50 lakh rupees or 20 lakh rupees or 15 lakh rupees in a fund, and you don't require this money and it remains invested, you are not liable to pay any taxes. All the money can keep growing, accumulating. That is not the case with the income from Senior Citizen Savings Scheme. The income is taxable. The interest income from bank deposit is taxable, even if you have chosen a cumulative plan that all the money will accumulate, but withholding tax will be deducted every year. So I would say that go for a conservative investment, maybe a equity saving scheme or something which has a very nominal, a small allocation to fixed income, and that way you will actually leave a larger state. The money will grow faster than Senior Citizen Savings Scheme on any 5-year time period.
Okay.
And you will not be liable for any taxes on the growth in the interim.
Besides the risk angle, what are the other factors that we should look while investing in small cap funds? Should we invest in them over the next 12 months? And this is the question from Bala Subramaniam.
Two things one should look for when look closely when investing in a small cap fund. One is that a small cap fund should be small. A very large small cap fund is a very difficult thing to manage. It loses its charm because the small cap stocks, looking at 20, 30, 40, 50 ideas is more than enough. And small cap stocks normally have low liquidity. Okay. So finding 500 of them, because if a fund is running a 10,000 crore small cap fund, it's very difficult thing to manage. It loses its edge. So one is the size of the fund. The other is that, you should be investing in small cap fund with a 5 to 7 year, at least 7-8 year time frame. And discipline is important because small caps struggle for a long period of time, and all the returns come in a much narrower time frame. When they do well, they go ballistic, and most of that return will come. So it requires extreme patience. It requires extreme courage that you are investing for many years, and still it remains low. It keeps going down. So if you have that temperament, and so look for a small cap fund, okay, and invest.
Mehul Thakkar says that, and he's asking you how would you call the current market scenario? A bubble phase or a bull phase? And what should be the investment strategy?
There is a bubble looks like, there is all kind of things are there in the market right now. There's a bear phase as well, though he has not asked for it. If you look at what has happened to small caps and mid caps in the last 2 years, looks like there's a bear market. If you look at the large cap index, looks like a bull market. If you look at the high quality segment of the market, companies which are profitable, they have high return on equity, those 30-40 companies which have done exceptionally well in the whole market decline, they have refused to fall in line with the market. They are extremely expensive, and they have become even more expensive on the price-earning ratio in terms of their own prices, though they might have corrected a little bit. So we have the bull market, we have the bear market, and we have the everything is happening. Okay. And they're all defendable, they're all justifiable. All kind of theory is going around. I would say that is why you should diversify. Everything works in the market. A segment of the market will turn around. reversion to mean always happens in the market. So what has done very poorly will start doing well. What has done very well will not do as well. Where we see the excesses, the bubble, the high quality businesses, they may correct. And even a nominal correction while the other rest of the market is going up might look like opportunity loss. So that is why you should diversify.
Okay. Gaurav Ghosh has written in saying that, is there any difference between ELSS and a multi-cap fund apart from the tax relief?
There is a difference between ELSS and a multi-cap fund apart from the tax relief. Yes, your money gets locked in for 3 years, and you can't do anything about it. And except for that, no. Most of them are multi-cap fund or different kind of strategies being followed.
Okay. Would you suggest investing in algorithm-based quant funds in addition to multi-cap? Are such funds value-oriented? And this is from Jagdish Raila.
I would say that none of the algorithm-based strategy is old enough to say that yes, it works in a very sustained way. Okay. Some of it might work over time, but we still have to, and they all turn out to be nice story, to a very convincing story to begin with, but they need to really prove themselves. And I would say that for now, the active management, then algorithm, let it happen, let them prove themselves. And I haven't come across an algorithm-based quant strategy,
okay,
which is being implemented with great rigor over a long period of time, and has been able to stand out with long-term performance. Not as yet. Of course, most of them are value-oriented or growth-oriented, and they will. One advantage of any algorithm-based strategy is that they will be doing exactly that all the time. There's a great predictability in terms of what they're doing, what they will be doing. But I think, for now, active funds stand a chance.
Okay. Sanjay Rawat has written in saying that, what are the basic concepts to select the right fund for a beginner?
The first thing is choosing the appropriate kind of fund. For a beginner, it is very important to choose the right kind of fund rather than the best fund. Because if you choose the inappropriate kind, then you will get a surprise. For example, if you're looking at fairly conservative return and you are not prepared for any big decline, then even starting with a very conservative equity saving fund will be risky for you. Likewise, if you are looking at aggressive growth and you invest in a nice balanced fund, that could be disappointing for you. So choosing the right kind of fund, understanding what your time frame, your temperament, and in line with that. So that's the first step. Then comes, choosing a fund which will do well rather than what has done well. And all that we provide at Value Research is all kind of inputs, but nothing is there which is very predictive. We don't know. You look at the star rating and you get guided by that. A star rating is just a nice composite measure of risk and return. It is not it is not a recommendation to buy. But 5-star fund, and people buy it with the understanding that, okay, it is a 5-star fund. It is nothing but because it only saves you from the hassle of looking at 1-year return, 3-year return, how volatile it has been.
It has been vetted by
we try and no, it is not vetted by Value Research. Okay. It is just based on the past performance. Okay. And it is a composite measure of how volatile the fund has been in relation to the return it has delivered. So a 5-star fund means that, and that too in the past, not in the future. Okay. A 5-star fund can actually be a horrible fund from tomorrow and we can't do anything about it. Till that, poor performance gets captured in the rating methodology. So then look at, but 5-star funds or 4-star funds is a good measure to it. It's an initial filtering system. After that, apply some 1 or 2 qualitative filter that the fund manager has been around for 5 years and more. And the fund has done consistently well in a rising market as well as falling market. If you are able to check at these 3 numbers, I think, you will end up with so appropriate fund, consistent performance, the man being around, and then your own discipline of investments.
Okay. How safe are the retirement funds offered by the mutual fund companies? This question has come from Siva Subramaniam.
All the retirement funds offered by mutual fund companies are hybrid funds. In retirement, small equity allocation, accumulation for retirement, large equity allocation. And they come in 2-3 formats, 2 or 3 allocation, less equity, more equity, and a balanced portfolio. So they are just as safe as, the market or any other mutual fund. But by the design of it, mutual funds are reasonably safe. But they're not insulated from the market risk. If markets go down, these funds will decline in value. The design of it is something which I think is quite sensible. It's a simple mechanism that 80% fixed income, 20% equity for income orientation is a right allocation. Or, you don't know the perfect allocation. Okay. But broadly following the principles of in your safe accumulation, they are reasonably, if you're methodical about it, they could be quite useful.
Well, that's all we have in today's program, Dhiren. Thank you so much for answering the queries and throwing light on the economy. As Dhiren said, very simple. Like a stuck record, we say, keep investing. That's important. Keep investing regularly. Till we meet next time, it's goodbye. Take care.